everybody, and welcome back to video number 5 in chapter 18. And when we left off, we were looking at examples of temporary and permanent differences using biotech company. And they report pre-tax financial income of $200,000 in each of the years 2023, 2024, and 2025. The company is subject to a 20% tax rate and has the following differences between pre-tax financial income and taxable income. Here, it pays life insurance premiums for its key officers of $5,000 in 2024 and 2025. Although not tax deductible, biotech expenses the premiums for book purposes. The following, here is an illustration. The following is a reconciliation of biotech's pre-tax financial income to taxable income and the computation of income taxes payable. So here's our pre-tax financial income, our permanent difference, non-deductible expense here, and they also have an installment sale here, and taxable income as calculated here, and income taxes payable based on 20% tax rate here. Okay, now we'll take a look at that information. And alpha, does the temporary difference impact the future? And then Bravo, what are the journal entries at December 31, 2023, 2024, and 2025 to record income tax expense, deferred taxes, and income taxes payable? For alpha, we'll go back real quick. Here's alpha. How does the temporary difference impact the future? In 2023, the originating temporary difference is caused by installment sales of $18,000. The $18,000 is included in financial income, but excluded from taxable income. Therefore, your taxable income is less than financial income, which creates a future taxable amount and a deferred tax asset. The temporary difference will reverse in 2024 and 2025. So the note here is that there is no deferred tax amount associated with the difference caused by the non-deductible insurance expense because it is a permanent difference. Okay, so for Bravo then, as we record the journal entries at December 31, 2023, we're going to have $36,400 plus $3,600 or $40,000 of income tax expense, and that's computed by taking 20% of $18,000 or $3,600 deferred tax liability, and income taxes payable based on $182,000 for $36,400. And if we look back at the numbers here, there they are. Now, in 2024, we do a similar calculation, and we calculate the deferred tax liability of $12,000 times 20% and $217,000 times 20% to calculate these numbers. Similarly, in 2025, we do a similar calculation. The biotech has one temporary difference, and that originated in 2023 and reversed in 2024 and 2025. It recognizes a deferred tax liability at the end of 2023 because the temporary difference caused causes future taxable amounts. As the temporary differences reverses, biotech reduces the deferred tax liability to zero. Okay. Future tax rates. What happens if the tax rates are expected to change in the future? In this case, a company should use the enacted tax rate expected to apply when the temporary difference reverses and the tax impact is realized. For example, assume that Solar City at the end of 2026 has the following cumulative temporary difference of $300,000. And here is the illustration. The book basis of depreciable assets here, $1 million. The tax basis, $700,000. So the cumulative temporary difference of $300,000. Now we're going to assume that the $300,000 will reverse and result in taxable amounts in the future, with the enacted tax rates shown. The amount that reverses in each future year should be multiplied by the enacted tax rate for that future year. And you can see that these tax rates have changed over time from 20% down to 15%. And so the deferred tax liability would be based on differing tax rates. Okay, in most cases, a company will record a deferred tax asset or deferred tax liability at the current tax rate. When a change in the future tax rate is enacted, companies should record its effect on the existing deferred income tax accounts immediately. A company reports the effect as an adjustment to income tax expense in the period of change. So let's look at an illustration. Here, on December 10th, 2025, a new Income Tax Act is signed into law that lowers the corporate tax rate from 40% to 20%, effective January 1, 2027. If hostile company has one temporary difference at the beginning of 2025 related to a $3 million of excess tax depreciation, then it has a deferred tax liability account with a balance of $1.2 million, calculated by taking $3 million times 40% at January 1, 2025. Now, if the taxable amounts related to this difference are scheduled to occur equally in 2026 and 2027 and 2028, alpha, what is Hostel's deferred tax liability at the end of 2025? And Bravo, what journal entry would you make, if any, for Hostel as a result of the tax rate change? So the solution here for alpha is that the deferred tax liability at the end of 2025 is $800,000. And we compute that as follows here. Now, to recognize the decrease of $400,000, and that's the $1.2 million here, minus the $800,000 at the end of 2025 in deferred tax liability. So to recognize that decrease, we're going to debit deferred tax liability of $400,000 and credit income tax expense, reducing both those accounts by $400,000. Okay, here's some additional tax issues facts for the Johnny Bravo Company. who began operations in 2025 and has provided the following information. 1. Pre-tax financial income for 2025 is $100,000. 2. The tax rate enacted for 2025 and future years is 20%. 3. Differences between 2025 income statement and the tax return are listed below. So here is alpha. Warranty expense accrued for financial reporting purposes amounts to $5,000. Warranty deductions for the tax return amount to $2,000. Bravo. Gross profit on construction contracts using the percentage of completion method for books amounts to $92,000. Gross profit on construction contracts for tax purposes amounts to $62,000. And then for Charlie, depreciation of property, plant, and equipment for financial reporting purposes amounts to $60,000, and depreciation of these assets amount to $80,000 for the tax return. For Delta, a $3,500 fine for violation of pollution laws was deducted in computing pre-tax financial income. And finally, Echo, interest revenue earned on an investment in tax-exempt municipal bonds amounts to $1,400. 4. Taxable income is expected for the next few years. Okay, they want you to A, alpha, compute taxable income for 2025. Bravo, compute the deferred taxes at December 31, 2025 that relate to the temporary differences described above. And Charlie, prepare the journal entry to record income tax expense, deferred taxes, and income taxes payable for 2025. And as we look at alpha here, our taxable income, our pre-tax financial income was $100,000. We have permanent differences here, fine for pollution, tax-exempt interest. But we have originating temporary differences based on our warranty expense, excess profit on the books from depreciation, and then excess depreciation per tax. Here. Okay. And then Bravo, deferred tax assets and deferred tax liability. Here's our future taxable columns, and here's our deferred tax columns. Here's our warranty costs, construction contracts, and depreciation. And you can see for future taxable, we have $47,000. And then for deferred tax, we have a deferred tax asset here and a deferred tax liability here of $600 and $10,000 respectively. And then for Charlie, a fairly elaborate calculation. We have income tax expense here, our deferred tax asset here for $600, our deferred tax liability here, and our income taxes payable of $11,020 based on $55,100 times 20%. And how did we get that? We took, here's the calculation for that. That's the income taxes payable for 2025. And then our deferred tax liability here and our deferred tax asset here. Okay, that looks like a good place for us to end this video. And when we return, we'll take a look at our new objective of explaining accounting for loss carryforwards. Until that time, bye for now.